Don't get screwed. The most common thing people tend to ignore when getting a mortgage is the prepayment penalty. In fact, more than 70% of mortgages don't make it to the end of the term, and better yet, most don't even make it past 3 years. Hey guys, my name's Jarrett White with White Ridge Mortgage here in BC, Canada. Today, I'm going to be talking about the prepayment penalties that come along with most mortgages and compare different banks and how they actually calculate their penalties. If you haven't already, please hit that like button, subscribe, and ring the bell to be notified. It'd mean a lot and it really helps push this video in front of more people just like yourself. Without further ado, let's dive on in. So when you're talking about prepayment penalties, there really are two main kinds. And the prepayment penalty is basically the penalty you incur when you pay out your mortgage earlier than the term. So if you have a 5-year term and you pay it out in 3 years, you're going to incur a penalty. Or even if you have a 5-year term and you pay it out in 4.5 years, you're going to incur a penalty. So the prepayment penalty is what you're going to face if you're paying out your mortgage early. Now, before I can get into the two different types, it's important to know why you would actually break your mortgage to begin with. The most common reason is maybe you had a job relocation, or maybe you're just simply tired of that commute. The second most common reason is a separation with a partner, and honestly, there's countless other reasons why you might break your mortgage, such as you want to upgrade to a new home, maybe your job situation changes and you're not making as much money, maybe a health concern comes up and you can't work anymore, or maybe you simply just want to access your equity to do some renovations. The most common one that I think will start coming up in the next couple of years is simply just refinancing to get a lower rate, which in turn gives you a lower monthly payment. Having a large prepayment penalty can really sidetrack all those plans and really eat away at your equity. After all, the reason why you bought and didn't rent a home to begin with is to build equity, I'm assuming, isn't it? Well, why risk all that equity just by having a penalty that's costing you tens of thousands of dollars? And not to mention, when this penalty is combined with real estate fees to sell your current home and the property transfer tax to buy another home, it really does add up. And if you don't have much equity to begin with, it's pretty much all gone at that point. Okay, so now you know why you might break your mortgage. Well, what are the two different types of prepayment penalties? Well, you're going to come across one, a 3-month interest penalty, and that's exactly how it sounds. You have your monthly payment, they take the interest portion of that payment, and they just times it by 3. Now, to be honest, that actually isn't that bad, and that's why variable rate mortgages for the longest time have been a very popular choice, is because they have a maximum of 3-month interest as their prepayment penalty. However, if you do choose to lock in your variable rate to a fixed rate, which is a feature all of them have, then you're going to be paying a different penalty other than just the 3 months interest because it's treated as a fixed rate. The second most common, and it's commonly associated with fixed rate mortgages, is what's called the IRD, the interest rate differential penalty. This penalty is pretty much found on every single fixed rate mortgage in Canada, and that's what this video is really about, because the wording on how they calculate this penalty can make a major difference in what it actually ends up costing you. General rule of thumb, variable rate mortgages are always a maximum of 3 months interest if you're going to pay it out early. Now, fixed rate mortgages, what they do is they take the greater amount of the IRD penalty, that interest rate differential, or 3 months interest. So whichever one ends up being more, that's the one you have to pay. Major banks have the highest interest rate differential due to one word, and that word is posted. And I'll make that make sense in just a second here. But in order for that to make sense, you need to understand what posted rates are, current rates are, and contract rates are. So a posted rate is posted on the bank's website. And to be honest, if you were to look at them right now, they are quite high. At the time of making this video, interest rates are about 5%. But if you were to go look at the bank's posted rates, they're close to 7-8% right now. Now, the contract rate is the rate that you're actually receiving, and it's on your contract. That's the rate that you're paying on your mortgage. And the current rates are the rates being offered at the time that you're trying to pay out your mortgage. Now, with the major banks, what they do for their interest rate differential penalty is they take the posted rates that are currently way up here and they compare that to the current rates at the time of you trying to break your mortgage. So as an example, say you take a 5-year term, 2 years in, you want to pay it out early, you have 36 months remaining. So what they're going to do is they're going to calculate 36 months at the posted rate and then 36 months at the current rates, and they take the difference between the two, and that's what you pay. Due to the major bank taking the posted rate and not your contract rate, that's what's making you spend tens of thousands of dollars more on this penalty. We have other lenders such as monoline lenders in our network, You may have heard of a couple like First National, MCAP, RFA. They are fantastic lenders. They still are A lenders and they have very competitive rates. However, they have a more fair penalty calculation. So what they're doing is they're actually taking the contract rate compared to the current rates instead of that posted rate that's way higher. So let me just run you through an example. Let's say you take out a $500,000 mortgage and you have a 5-year term over 25-year amortization. Your monthly payment would be $2,908. The interest portion of that payment is $2,083. The posted rate, however, is 7.15, and the interest payment on that would be $2,979. Now imagine a situation where 2 years down the road, you needed to pay out your mortgage, meaning you have 36 months remaining. And at that time, interest rates were being offered for 4%. What they're essentially doing is they're calculating 36 interest payments at that rate of 4%, which is currently being offered, and they're comparing that to 36 months at 7.15, the posted rate. Just so I can show you how much this actually makes a difference, if you were to take 36 months at 4%, it would be $59,976. If you were to do the same thing with the posted rates where they're at 7.15, it would be $107,244. So now basically what we're doing is we're just taking the difference between $107,244 and $59,976. And that equals $47,268. So you would literally be paying more than $47,000 if you went with a major bank in a scenario like this. Now compared to a monoline lender where they're comparing the current rates to the contract rate, the rate that you actually have, this makes a huge difference and it ends up being $15,012. So it's $49,000 or $15,000. I'd take that $15,000 penalty any day of the week over $49,000. That means you're literally risking an additional $32,000 to go with the major bank. This is why it is so important to understand how these penalties work, because if one thing comes up in your life where you need to pay it out early, that could really destroy your financial situation, especially if you don't have much equity to begin with. And if you did build up some equity, well, there it goes, it's pretty much all gone. This is exactly why I tell all my clients that rate isn't everything. Rate is important, don't get me wrong, but if you can find a lender that has competitive rates, so not much higher, but has a way better prepayment penalty, I'd take that option all day long. Now, currently in our market right now, you can get rates with major banks close to the 5% range. If you were to go with a monoline lender, you're looking at about 5.25, so it's about 0.25% higher. Now, in that scenario that we ran with a $500,000 mortgage, that's going to equate to about $100 more a month. So if you think over a year, it's $1,200 a year, and over the whole term, it's about $6,000 bucks. So you are paying $6,000 more to basically have insurance of not paying $32,000 if something changes in your life. If that hasn't convinced you yet, well, we're still not even accounting for if rates were to come down. If rates come down, you actually still have the ability to refinance and reap the rewards of those savings and get a lower monthly payment. Whereas if you went into a major bank, there's no way you're making that back, that penalty, just by the interest rate drop. Even if rates were to drop 2 full percent, and you were to refinance, you still wouldn't make that penalty back. Whereas with a monoline lender, if they were to drop, that penalty isn't as bad. You can definitely still make the savings back and then have a lower monthly payment. So when I said you're saving $6,000 to basically risk $32,000, you got to understand that it does change. So the more interest rates go down, the more the penalties are going to be on both sides. But the major banks will always be more drastic because that posted rate is so much higher. By going with a monoline lender, yes, you might be taking a slightly higher rate and have a slightly higher payment because of that. But you're also leaving the door open for future refinances that could save you way more than that initial amount that you're saving by going with a major bank. I really hope this video provided some value to you with how the prepayment penalties work. Now, if you did gain some value, please hit that subscribe button, like this video, and ring the bell to be notified when other videos just like this come out. It would mean a lot, and it really helps these videos get in front of more people just like yourself. Otherwise, thanks a lot, guys. Catch you on the next one.